As promised, here is a short exam review session. So I've just kind of developed a slide deck that's going to very quickly cover all of the main points or main topics from each of the 3 chapters that will be covered on Tuesday's exam. It's not meant to be a re-lecture of everything we've already talked about in class. I'm going to move pretty quickly, but this PowerPoint presentation and this kind of short review session will certainly highlight what I think is important for you to know coming into the exam on Tuesday. I've incorporated some examples. Sometimes the examples are for some of the more complicated topics that we talked about over the last few weeks, and then some are examples that I think are important but may not have been represented in your homework assignment. So I'll go ahead and get started. Again, I'm just going to quickly go through the information. If I say something or if I cover something and you have no idea what I'm talking about or you're confused, that would be a good indication that you need to go back to the class notes. You need to go back to the textbook and review that information, because if I'm talking about it today or right now, there's a good chance that there's going to be a question covering the same information on Tuesday's exam. All right, so I'm just going to start with Chapter 1 and kind of quickly work through Chapter 3. Chapter 1, the important concepts. The first one, what is a tax? So in class we talked about the characteristics of a tax. Again, it's not voluntary, it's mandatory. It doesn't provide or ensure that you receive something specific. A tax is a payment that you're required to make for kind of the general purpose of providing the government revenue for the government to provide services to its constituents. So you should, after looking at your lecture notes, or maybe you recall it from when we talked about it in class, but the registration fee that you pay for your car is not a tax, right? Because you're paying that fee for something very specific. You could avoid paying that fee if you choose not to own a car. So that would not meet our definition of a tax. Local property taxes, they do meet the definition of a tax. You have to pay your local property taxes even if you don't think that you're getting any benefit from paying those taxes. I think this is a good example because local property taxes typically go towards funding public education, and you're required to pay those taxes if you own property within a jurisdiction, regardless of whether you have children that attend the public school. Okay, so that's why it would meet the definition of a tax. So again, I think that's a pretty basic concept, but you should be kind of comfortable with that coming in on Tuesday. Okay, the next thing we talked about in Chapter 1, we talked about the basic tax formula. So tax revenue, that's the tax that the government is collecting. The very basic formula is that the tax revenue equals the tax base times the tax rate. We talked about how a rate can be a flat rate or it can be a graduated rate. A graduated rate is going to be a rate that changes with your income. A flat rate is going to be like the sales tax, where every purchase is subject to the same rate of tax. We talked about the tax base. So the tax base is going to change depending on which type of tax we're talking about. So the tax base is what is being taxed. So for the income tax, the tax base is your annual income. Property taxes, the tax base is the fair market value of the property. Employment taxes, the tax base is your salary or the wages that you're paid by your employer. So the tax base is what is being taxed, and it changes based on the type of tax we're talking about. So based on this tax formula, you should be able to provide a few examples of how a government might be able to increase tax revenue. So they can increase the tax rate, and they can also manipulate the tax base. So you should be familiar with those concepts on Tuesday. After talking about the basic tax formula, we talked about different ways that we can measure tax rates. Talked about the marginal tax rate, so that's the dollar of tax that you're going to pay on your next dollar of income. And again, we find the marginal tax rate from the tax tables. I will provide the tax tables on Tuesday's exam. You do not have to bring a copy. You don't have to include the tax rates on your crib sheet. I'll provide you that information. But that's the marginal rate. The average tax rate is going to be our tax liability divided by our taxable income, and then our effective tax rate is going to be our tax divided by our total income. So there were 2 examples of kind of what I might be looking for in the exam, in your homework assignment. I think this is a concept that people generally got. Mistakes that were made on the homework were not dealing with the correct amount of taxable income. Okay, so recall that state bond interest and municipal bond interest is not taxable. So if you're provided information like that, you would exclude that from your taxable income when you calculate the amount of tax a taxpayer is due. So while we wouldn't include that income to calculate the tax, we would include that income in the denominator when we're looking at our effective tax rate. It's part of our total income, not part of our taxable income. Okay, so that's the most common mistake I saw on the Chapter 1 homework assignment. Again, the Chapter 1 solution is up there, and then hopefully after reviewing that solution, everyone felt a lot better about those problems. Okay, so there's 3 ways that we can measure our tax rates. The type of tax rate that we really concentrate on in this class is the marginal rate. Okay, so that's most important in calculating your actual tax liability, most important when we talk about tax planning. That's the rate that we'll want to use. Okay. So then we talked about, so this is something that I don't think is covered very heavily in your textbook, but something that I discussed in class. It's in your lecture notes, and I think it's important. And this is just how we incorporate the impact of taxation into our decisions. Okay, so anytime we do something that results in additional income to us, or anytime we do something that results in a tax deduction, these types of transactions are going to change our tax payment situation. Typically, if we increase our income, that income is going to have a tax cost associated with it most of the time. So if we have municipal bond interest, we just talked about that, that's not taxable. So that would be an exception, but there aren't many exceptions. So most of the time, if we have additional income, we have to pay tax on it, okay? And so if we are anticipating receiving additional income, it might be beneficial for us to anticipate how much tax we're going to have to pay, and then figure out how much cash is going to be left over after we make our tax payment. Okay. Similarly, with tax savings, anytime, especially for businesses, so most of the expenses we would have to pay, or the bills we would have to pay associated with operating our business, most of the time those are tax deductible. That means we get to offset our gross revenue by these deductions. We're only paying income tax on our net income. So anytime we have a deduction, that's going to drive our taxable income down, reduce our taxable income. And anytime we reduce our taxable income, that's going to correspond to a lower tax payment. So when we're looking at tax deductions, what we want to think about is how much are we saving in our tax liability? How much is our tax bill going to go down because of this deduction? So that's tax savings, okay? And anytime a deduction results in tax savings, then we can think about the after-tax cost of an expense. And so the after-tax cost is going to be the gross amount of the expense, the amount of cash we pay to kind of satisfy that bill that we've received. So that's the cash that's leaving our organization. We always want to net that with the tax benefit that we receive from paying that bill. We want to net the total cash going out with our reduction in tax, or the cash that we get to keep because we've paid that bill, looking at it from a tax perspective. So that's going to be the after-tax cost of an expense, okay? And so here we have, again, tax cost is associated with additional income. So make sure you are able to calculate after-tax cash flows. Tell me what a tax cost is, and then tell me how much cash is left over after a taxpayer has made their tax payment, okay? So let's say a taxpayer's marginal rate is 20%. She receives a $10,000 bonus. Her tax cost, the tax that she owes on this bonus, is going to be the amount of additional income times her 20% marginal tax rate. So her tax cost is going to be $2,000. And then you should also be comfortable with this concept of after-tax cash flows. How much cash is left over? She has $10,000 coming in. $2,000 is going out to pay her tax liability, leaving her with after-tax cash flows of $8,000. Okay? And then tax savings, we're looking at deductions. So let's say we have a taxpayer with a marginal rate of 20%. He finds an additional deduction worth $12,000. What is the tax savings and what is the after-tax cost of that expense? So if you're provided with the marginal rate and the amount of the deduction, to figure out the tax savings, you take the reduction in the income times the marginal tax rate of 20%. So this taxpayer's tax savings is going to be $2,400. Okay, again, that's the amount that his tax liability is reduced because he's paid this expense. And then we can look at the after-tax cost of this expense. So he's paid $12,000. However, when he goes to pay his tax bill is going to be $2,400 less. And so if we net those two numbers together, what's really the true economic impact of the taxpayer incurring this bill is $9,600. Okay, that's really what he is out on a cash basis, $9,600. $1,200 going out, but $2,400 he gets to keep of his cash because of the tax impact of that transaction. Okay, so we want to look at expenses. We want to look and concentrate on the after-tax cost of these expenses. Okay, because the before tax $12,000. If the taxpayer is able to deduct the expense on their tax return, the after-tax cost of that expense is going to be something less than the before-tax cost. Okay, so we want to factor in the tax benefit of paying these bills. Okay, all right. So the examples that I provide on this slide are pretty easy. I think pretty basic examples. I give you one marginal tax rate. And you can just assume that if I would give you a question like this, where I tell you the amount of an expense, the taxpayer's marginal rate, and ask you for the after-tax cost, you can just assume that the deduction, after the deduction, the taxpayer remains in the same marginal tax rate. Okay, so because you're not given any information about total income, you can just assume that the entire deduction is going to save the taxpayer at the rate of at the marginal rate that you're provided. Okay, and so this kind of relates to the more complicated problems we looked at. So in your homework assignment, I gave you information. Well, here's the taxpayer's total income, and then he or she earned additional income, and I wanted the tax cost of just the additional income. Okay, if you're given total information like that, if you're given total taxable income, and you know what the taxable income before the additional income and the taxable income after the additional income, then that calculation or that analysis can become more complicated, right? If you're given information like that, then you need to go to the marginal tax rate, and you need to see if that additional income has pushed the taxpayer into a new marginal tax rate or not. Okay, if the additional income or the additional deduction has moved the taxpayer into a different marginal rate, then the calculation becomes more complex. And those are the type of calculations that showed up on your homework assignment, right? So you have additional income. Some of that income might be taxed at 20% and some at 25%. And so you need to kind of consider the change in the marginal tax rate when you're calculating the total tax cost of this additional income. And the same thing with deductions. If the deduction pushes a taxpayer into a lower tax rate, then the calculation becomes more complex, and it's similar to what you saw on your homework. Okay, the examples that I provide on this slide are easier examples because you're not given total income. You're just given the amount of the income increase or the amount of the additional deduction and the marginal tax rate. On the exam, if the information is presented like this, then to find the tax cost, you can simply take the additional income times the marginal rate given and assume that that marginal rate applies to 100% of the additional income. Okay, and the same thing with the deduction. If you're told that the taxpayer has a $12,000 deduction, the taxpayer's marginal rate is 20%, and this is the extent of the information provided, to tell me what the tax savings is, you can just assume that that 20% marginal rate applies to the total amount of the deduction that's given. Okay, and so hopefully that makes sense, especially those of you who really took a lot of care in doing your homework assignment. You should know exactly what I'm talking about. The homework is a little bit more complicated. However, on the exam, if you're given a more simple example like that is provided on this slide, just take the information that's provided and run with it. Okay. If you're not given total income, then you can just use the marginal tax rate for the entire increase or decrease in taxable income. Okay, so you should be familiar with these topics. You should be able to calculate tax cost. You should be able to calculate tax savings. You should also be able to take it one step further. And if we're dealing with additional income, you should be able to provide the after-tax cash flow of that additional income. And if you're provided an additional deduction, you should be able to provide the after-tax cost of that deduction. Okay. So kind of looking at this concept of tax cost and tax savings, if we could choose, if we have income, we'd want an entity with a lower tax rate to report that income, right? The higher the tax rate, the the higher our tax payment and the lower our after-tax cash flows or our after-tax income, okay? And then for deductions, if we could choose, we'd want to shift deductions to higher our taxpayers with a higher marginal rate, okay? The higher the marginal rate for deductions, the more the tax savings is going to be, okay? An increase in the marginal tax rate is going to increase the tax savings associated with that deduction, okay? And so we'll talk a little bit when we come back after the first exam. We're going to finish chapter 3, and we'll talk a little bit about income shifting, and it's all based on these principles. If we can, we want income to be reported by low tax rate individuals or entities, and for deductions, we want deductions reported by high tax rate individuals or entities, okay? So hopefully, these concepts make sense. Then we talked about tax rate structures, okay? So we can have a structure that has a proportional rate. That's a flat tax. That means the same tax rate applies at all levels of the tax base. We have progressive tax, so a proportionate tax kind of for the types of taxes that we're used to or that might apply to us. A good example of a proportionate tax would be the sales tax, right? It doesn't matter the cost of what we're purchasing, the sales tax rate is going to remain constant over all purchases. That's a proportionate structure. A progressive structure uses graduated tax rates. Our tax rates are going to increase with our tax base. This would be the income tax system. The higher our income, the higher our marginal rate becomes, right? The marginal rate increases as our income increases. And then finally, we might have a regressive tax structure. So this would be a declining marginal tax rate as our tax base increases. Okay, so the best example for a regressive tax in taxes that we're familiar with would be the Social Security tax, right? So the Social Security tax is going to be a flat percent up to a certain point, okay? For this year, that certain point is $117,000. Once our wages are in excess of $117,000, our Social Security tax rate becomes zero on anything in excess of $117,000. So that would be a regressive tax structure. As our income increases, our marginal rate actually becomes zero, right? Additional dollars are not subject to the Social Security tax. So that would be a regressive tax, okay? The next thing we talked about were important taxes by each level of government. And so the way kind of our tax system is structured here in the U.S. is that each level of government tends to rely on a different type of tax. So the federal government relies very heavily on the income tax. That's the biggest source of tax revenue for the federal government. The federal government imposes an income tax on both individuals and corporations. After the income tax, we have employment taxes. That would be your Social Security and Medicare taxes. That's an important source of revenue for the federal government. And finally, the federal government imposes transfer taxes. These are estate and gift taxes, okay? And then kind of below the federal government, you might have to pay taxes to your state government. State governments tend to rely on income taxes and then sales tax. So those are the two types of taxes that state governments rely on to bring in most of their tax revenue. And then finally, local governments tend to rely very heavily on property taxes. Okay, I think more popular would be a real property tax. Okay, so that would be taxes you'd have to pay on your home or on your business or manufacturing facility that's located within a town. But local governments could also impose a personal property tax. Personal property is anything that's not real estate. So personal property would be like inventory or cars and boats and airplanes. So these would be personal property. And local governments could also potentially impose a tax on personal property as well. Okay, so I think that's important to know just generally which types of taxes each level of government relies upon. Okay, so that might be good to know coming in on Tuesday. So I wanted to talk or just give one example of the sales and use tax situation, because again, I think this is an important concept that isn't maybe highlighted in the book. There was no homework assignment associated with the use tax, and so I just wanted to provide one more example so that everyone's prepared for what they could potentially see on Tuesday. So So what is it? So we know what a sales tax is, right? So this use tax is what state governments use to try to kind of prevent people from getting out of paying the sales tax. Okay, so what do I mean by that? So individuals, I think, are just, they're going to try to minimize the amount of sales tax that they have to pay. Okay, most people don't know that a use tax exists. Since they're not familiar with the use tax, they think that they're kind of having this benefit if they can purchase things outside of the state to reduce their overall sales tax liability. So how might someone do this? Okay, so people might go out of state. So a good example, when I was in Washington, the state of Montana does not impose a sales tax. And so if you live in Idaho, but kind of close to the Montana border, it would make a lot of sense for you, right? If you ignore the use tax, it would make a lot of sense for you to go into Montana and buy everything you need at the Costco in Montana instead of buying things in Idaho. Because if you go and buy it in Montana, you're not going to pay a sales tax on the purchase because Montana doesn't impose a sales tax. And so that's one example where you might go into a different state and purchase something because that state has a lower sales tax percent than your home state. Okay, I think what's more problematic for states are internet sales. Okay, so right now, the way kind of internet sales work, the way the sales tax rules work is that if you're a retailer, if you're selling things to customers, you're only required to collect sales tax in states where you have a physical presence, okay? Where you are physically located, you have a store there, or if you have a salesperson there, that would create a physical presence, and in those states, you have to collect a sales tax. If you are shipping things to customers out of state, if you're shipping things into a state where you do not have a physical presence, you are not required to collect any sales tax on those sales, okay? So I have an example on the slide. Let's say we're a ski shop in Vermont, okay? So if you have a customer that comes into your ski shop in Vermont, you would charge Vermont sales tax on all of those sales, okay? People are coming to you, that sale is happening in Vermont, and so you would charge Vermont sales tax on all of the sales you deal with out of your shop, okay? But let's say that you also can accept online orders, and so let's say I'm sitting in Connecticut and I find skis that I'd like to purchase from the ski shop in Vermont. The Vermont ski shop has no physical presence in Connecticut. They don't have a shop in Connecticut. They don't have any salespeople in Connecticut. So I'm simply contacting them in Vermont, paying with my credit card, and they're going to ship the skis to me in Connecticut. The way that this sale is going to work, because I'm sitting in Connecticut while I'm making this purchase, the Vermont ski shop they would not charge me Vermont sales tax, okay, because I'm not in Vermont when I'm making the purchase. So the Vermont ski shop would not charge Vermont sales tax on this sale. And they are also not required to collect Connecticut sales tax on this sale. So basically, if I'm sitting in Connecticut and I purchase the skis from this company in Vermont, the ski shop in Vermont is collecting zero sales tax. Okay, they do not have a responsibility, a sales tax responsibility on this transaction. Okay, so they have to collect sales tax within the state, but if they're shipping goods outside of the state from online purchases, then they're not collecting any sales tax. They're not required to collect Vermont sales tax on these purchases or these sales. And because they're not in Connecticut, they also do not have to collect Connecticut sales tax. Okay, so if I was making this purchase, then I get my skis, and I've paid zero sales tax on this purchase. Okay, so I might think that I'm really smart because I've avoided the Connecticut sales tax of 6.35%. But if I'm a very honest taxpayer, I would have a use tax responsibility, and I would pay the use tax associated with this purchase. Okay, so what is a use tax? Anytime you purchase something out of state, okay, then potentially you're subject to the use tax. If you purchase something out of state, or if you purchase something online and you haven't paid a sales tax, then you're potentially subject to the use tax. The use tax is basically going to be the difference between what you should have paid if you made that purchase in your home state and the amount of sales tax you paid to a different state on that sale. Okay, so let's look at the example. So let's say I own a small business in Connecticut. The sales tax rate in Connecticut is 6.35%. This year I traveled to New Jersey and I purchased $500,000 of goods in New Jersey. So I travel to New Jersey, I buy the stuff there, and I bring it back to Connecticut to use in my business in Connecticut. Okay, so let's just assume that the New Jersey sales tax rate is 5%. I don't know if this is accurate, okay, it just works well for my example. So if you're from New Jersey and you know I'm wrong, my apologies, it's just for the sake of having a decent example, okay? So let's just assume that the New Jersey sales tax rate is 5%. So when I purchase this stuff in New Jersey, I've paid a 5% sales tax, and then I bring it back to use in my business in Connecticut. Okay. Let's also assume that I travel to New York and I purchase $500,000 of goods in New York, and I bring these things back to Connecticut to use in my business in Connecticut. Again, this is just for the sake of an example. I'm not sure if this is 100% accurate, but let's just pretend that the sales tax rate in New York is 8%. Okay. So based on this information, I'm in Connecticut, I travel to New Jersey and buy some stuff, I travel to New York and buy some stuff, and I bring it all back to use in my business in Connecticut. So how much sales and use tax would I have to pay on these transactions? Okay, so let's first look at the New Jersey purchase. So I travel to New Jersey, I buy $500,000 worth of stuff there. Okay, assuming New Jersey has a 5% sales tax rate, and the amount of sales tax I would have paid when I made that purchase is $25,000, okay? That's what New Jersey would have collected at the point of sale, okay? Because remember, sales tax is collected at the time you make the purchase, and it's the person selling the goods that's responsible for collecting that tax, okay? So I would have paid $25,000 when I purchased the goods in New Jersey, okay? I wouldn't pay use tax to New Jersey. You only pay use tax to your home state. Okay, so dealing with New Jersey, I would pay sales tax there when I purchase the goods. I would pay no use tax because use tax is only a tax you pay to your home state. Okay, then let's look at New York. So New York, I also purchased $500,000 worth of stuff. At the time that I made the purchase, I would have paid New York's 8% sales tax because I made the purchase there. So the sales tax that I would have paid to New York would have been $40,000, okay? Again, I would not have paid a use tax to New York because I would only pay use tax to my home state, okay? So then let's go to Connecticut. I would have paid zero sales tax to Connecticut because I didn't purchase anything in Connecticut, right? So my sales tax to Connecticut would be zero, but I might have a use tax responsibility or use tax liability in Connecticut. So again, the use tax that I would have to pay would be the difference between what I would have paid in Connecticut and what I actually paid when I purchased the goods. So for this example, I would only pay a use tax on the goods that I purchased in New Jersey, okay? Because I would have had to have paid 6.35% had I purchased this stuff in Connecticut. I kind of got a deal when I went to New Jersey, right? I only paid 5%. So this difference of 1.35%, that becomes my use tax responsibility to Connecticut, okay? So the use tax I would have to pay to Connecticut on this sale would be, the $500,000 of stuff I bought times 1.35%, the difference in what I would have paid in Connecticut compared to what I actually paid to New Jersey. Okay, so that would be the use tax for that purchase. For the New York purchase, I wouldn't pay any use tax because I paid more sales tax to New York than I would have paid to Connecticut. So for the New York purchase, there's no use tax liability there, okay, because the amount I paid is in excess of what I would have paid had I bought that stuff in my home state, okay? So this is a use tax example, and you should be familiar with this. You should be able to kind of given a scenario where you have somebody and they're purchasing stuff either online or they're purchasing stuff out of state, you should be able to tell me what the use tax responsibility would be for that individual taxpayer, okay? So if we just kind of change up this example, just slightly, let's say that instead of traveling to New Jersey, I ordered stuff online, okay, from the comfort of my home. I ordered stuff online from a company that's located in New Jersey, and I had them ship the stuff to Connecticut, okay? If this company isn't physically located in New Jersey, or excuse me, if this company isn't physically located in Connecticut, then the company has no responsibility to collect any sales tax whatsoever on this sale to me as they ship the things to Connecticut. Okay, and so if this would be the case, if I bought it online, then I would have paid $0 in sales tax, right? And if I paid $0 in sales tax when I made this purchase, this online purchase from a company only located in New Jersey, then my use tax liability on the sale would have been $500,000 times 6.35%, okay? Because I would have paid zero sales tax at the point of purchase. When I got that stuff in Connecticut and I thought about my Connecticut use tax, my use tax would have been the purchase price times the full 6.35%, okay? Because that would be the difference between what I would have paid in Connecticut and what I actually paid on the purchase, okay? So I think that's what states are mostly worried about, okay? They've kind of ramped up the use tax audits and use tax worries because they're trying to get people who are buying stuff online and not paying any sales tax whatsoever, okay? So that's the sales and use tax, and you should be comfortable with that concept and comfortable, telling me the amount of sales tax, the amount of use tax someone would have to pay if they're making out-of-state purchases, okay? All right. So kind of the next topic from Chapter 1, we talked about implicit taxes, okay? Implicit taxes, sometimes you'll accept a reduced rate of return. You'll choose one investment over another, even though the rate of return is lower. And the reason you would make that decision is because the income you receive from certain investments is tax-free income or tax-preferred income. Okay, so this is the state and municipal bond example. Okay, so we had a homework question that talked about this, and everyone overall did pretty well with this concept. There's a full explanation for the Chapter 1 homework problems that dealt with this. So I'm not going to recover everything, but I will go through one more example, okay? And this example, now we're going to compare 3 investments, okay? So let's say you have $50,000 to invest and you're considering 3 alternatives. Investment A is a corporate bond. Anytime you see corporate bond, you should, immediately know that corporate bond interest is fully taxable at your marginal tax rate. So investment A is a corporate bond that offers a 9% rate of return. Investment B offers a 7.5% rate of return, so a lower rate of return, but the benefit of making this investment is that the investment income that you receive would be considered long-term capital gain, okay? And long-term capital gain is taxed at 15%, okay? So there's an implicit tax associated with this investment. You are accepting a 7.5% rate of return instead of a 9% rate of return. Why would you do that? Why would you give up some of the return? The reason you would sacrifice some return is because you're getting income that's taxed at 15% instead of income that's taxed at your higher marginal tax rate, okay? And then finally, we have investment C. Investment C is a municipal bond. Anytime you see municipal bond or state bond, your initial reaction should be that's tax-exempt income, tax-free income, and this bond offers a 6.5% rate of return, okay? Again, the muni bond does not have to pay as high of a rate of return as the corporate bond because you're not paying any income tax, okay? Your tax rate for a muni bond interest is 0, right? You're not paying any tax. Explicit tax. The implicit tax you would pay on this municipal bond, the implicit tax you would pay when you compare it to the corporate bond would be the 2.5%, right? The 2.5%. The difference in the rate of return you could have gotten had you invested in the corporate bond with the rate of return you're receiving from the municipal bond. So that implicit tax is 2.5%, but your explicit tax is 0, okay? And again, hopefully you paid attention for the homework and you know exactly what I'm talking about, and none of this is new or surprising to you, okay? If this is new or surprising to you, then you have some work to do, and make sure you study hard before you come into Tuesday's exam, okay? All right, so we have these 3 alternatives, okay? One is taxed at the marginal rate, one is taxed at 15%, and one is tax-free, okay? They all offer different rates of return, so how are we going to decide? Okay, which investment should you choose? So to make this decision, you need to know what your marginal tax rate is. So your marginal tax rate is 25%, okay? So what we need to do in this situation is we need to convert all of these rates of return into an after-tax rate of return, okay? Because right now, these gross rates of return do not, like this 9% and the 7.5%, those reflect the rate of return before you pay your taxes, okay? What we want to know is what is the rate of return after we pay our taxes, okay? That's the important number. So we're going to convert all of these kind of before rates of return into after tax rate of returns, and then we can make our decision, okay? So let's look at the corporate bond, okay? So the corporate bond is offering a 9% rate of return. To convert a before tax rate of return into an after tax rate of return, we take the before rate of return, the 9%, we take that times 1 minus the tax rate we would have paid on that income, or that we will pay on that income, and that's going to turn that before number into an after-tax number, okay? So the before rate is 9%, we take that times 1 minus the tax rate that would apply. The tax rate that applies to this income is 25%, okay? So we would take our 9% return times 1 minus 0.25, that's 1 minus the marginal tax rate, and if we do this calculation, we would know that our before return is 9%, but after we pay our taxes, okay, and we take our after-tax return and we figure out, you know, how much return have we actually made incorporating the tax impact, our after-tax return is only 6.75%, okay? So we're taking a number and then just incorporating the tax impact, okay? So it's 6.75%. Then we can look at investment B, okay? Investment B is offering a 7.5% rate of return. This is our before rate of return. Again, to turn this into an after-tax rate of return, we start with our before return and we take it times 1 minus the tax rate that applies to that income, okay? So the tax rate that would apply to 15% income or long-term capital, the tax rate that would apply to long-term capital gain income is 15%, okay? That's the tax rate on this income. So when we put that information into our calculation, we start with our before return of 7.5% times 1 minus the tax rate that we will pay on the income. In this case, it's 15% to find our after-tax return, okay? So for long-term capital gain income, a before tax rate of return of 7.5% corresponds to an after-tax return of 6.375%, okay? So again, converting a before number into an after number, okay? And then finally, we can look at our muni bond investment. So the municipal bond is offering a 6.5% rate of return. This is the before rate of return and the after-tax rate of return. There's no tax consequence, right? We're paying no tax at all on this municipal bond investment. So our before and after amounts are the same. So for the muni bond or investment C, our after-tax rate of return is 6.5%. Okay, so now we have the rate of return for each of these investments after we've incorporated the tax consequence of making that investment. Okay, and now we can make our decision. We want to compare apples to apples. Okay, so we want to compare, you know, the rate of return for each investment only after we've incorporated the tax impact. That's truly what we're going to get, okay? This represents our true after-tax cash. And so we'd want to choose the one with the highest rate of return, right? So if we were kind of going to order these investments into most attractive to least attractive, the corporate bond is our best bet, okay? That we'd want to make that investment because it provides the highest after-tax rate of return. After the corporate bond, the municipal bond is second best, and after the municipal bond, investment B, that kicks out long-term capital gain income, that would be the third best, okay? So what's kind of different about this example, what makes this example a little bit more difficult than what we talked about in class, is it incorporates kind of this other type of income, this 15% income, okay? But again, it doesn't change the calculation at all, but here's an example, and you should be comfortable with this type of example for Tuesday's exam. All right, so the final thing for Chapter 1 is looking at ways we might evaluate different tax systems to see if one's better, one's worse, one's fair, one's unfair. So there's a number of factors we can look at to decide, you know, how well a tax structure is operating. The first one is sufficiency. Okay, so sufficiency is this concept: is the tax system generating the amount of revenue that the government needs in order to fund all of its operations? So right now, the current federal income tax system is insufficient. Okay, we're operating at a huge deficit every year. The national debt is increasing. So right now, our current system is insufficient in generating the amount of revenue that the government needs. Okay, so when we're looking at how we might change the system to make it more sufficient, okay, to increase the sufficiency of the tax system, we'd want to consider the income versus substitution effect. Okay, we discussed this in class. The income effect says that if we increase someone's marginal tax rate, they're going to work harder. Okay, they're going to do whatever they need to do to increase their before tax income to make sure that they have the same after tax income. Okay, so we went over an example of that in class. That's a taxpayer that has $50,000 of income. If he or she is currently subject to a 10% marginal tax rate, then the tax cost on that $50,000 of income is $5,000, and this person's after-tax cash flow is $45,000. Okay, what the income effect says is that if we increase that taxpayer's marginal rate from 10% to 15%, and their income stays at $50,000, then their after-tax cash flow is going to decrease, right? If their before income doesn't change and we increase their tax rate, then they have less after-tax cash to survive. So the income effect says that if we do that, if we increase the rate, that people are going to work harder and they're going to increase their before tax income, okay? And so if the income effect applies, then an increase in the tax rate would actually increase the amount of revenue coming into the federal government. People are going to work harder. They're going to increase their before tax income, okay? There's another maybe prediction of what might happen if we make changes to the tax system. That would be the substitution effect. Again, the substitution effect says if we increase taxes too much, people are going to say, I'm done. It's not worth my time and effort to work outside the home, and so I'm either going to drop out completely. Okay, so maybe there's a household that has two spouses that are both working. If we increase the tax rate, maybe one of those spouses says, I'm done. I'm going to stay home and take care of the kids instead. That would be the substitution effect. Or maybe it's a single person and their tax rate increases from 10% to 15%, and they're already working pretty hard and they don't want to work any harder. So they're not going to increase their efforts. They're just going to deal with lower after-tax cash flows. Okay, so you would need to, anytime you think of what could we do to increase the tax or increase tax revenues or change the tax system, you always need to anticipate what taxpayers are going to do. And these are two general assumptions that you can make, okay? So you'd have to consider whether the income effect is going to override the substitution effect or vice versa, and that will influence your projections of how successful changes to the tax system might be, okay? So that's sufficiency. We talked about equity. The homework assignment had a bunch of questions about equity. On the solution, I provided clear explanation of horizontal versus vertical equity. So, you can go there and just stop by if you have questions regarding equity, but hopefully that's pretty clear at this point. The next thing that we might evaluate is certainty. Certainty says that taxpayers should be able to determine when to pay their tax, where to pay their tax, and how to calculate their tax. The next one is convenience. It says that a tax system should make it convenient for taxpayers. The collection of the tax should be convenient for them. So we might consider convenience when we're looking at comparing tax systems or considering changes to a current tax system. And then finally we have economy. And economy, this principle of economy states that a tax system should minimize the cost of compliance and the cost of collecting the tax. Okay, so I think that maybe our current system is failing a bit on the convenience. Well, I'm sorry, not on convenience. I think our current system is maybe failing a bit on certainty. So we know when to pay the tax, we know where to pay our taxes typically, but I think the tax calculation can be pretty complicated sometimes for taxpayers. Convenience, I think that the system does an okay job with convenience. It's for us to pay our sales tax responsibility. We don't even have to think about it, right? So it's very convenient for the taxpayer to pay sales tax because whoever we're purchasing goods from, they're actually the ones that are responsible for collecting and remitting that tax. That's pretty convenient for us. The fact that our employer withholds some of our income and prepays our federal taxes for us, that's kind of a convenience issue as well. Okay, economy, maybe the tax system currently is not doing so well. I think most people, I think a high percentage of taxpayers employ a paid preparer, and and that's expensive, right? So but everyone, these are all subjective type things, but you should know that tax system can be evaluated on these 5 different principles. Okay. All right. So Chapter 2. Chapter 2, the first thing we talked about were taxpayer filing requirements. Who has to file a return? So all corporations have to file a return, regardless of whether they have income or loss. We talked about that. We talked about individuals. They have to file if their gross income exceeds the total of their standard deduction plus their personal exemption. On the exam, you'll be provided with the standard deduction amounts, and you'll be provided with the amount of the personal exemption for 2014. So you'll have that information. You'll be able to compare that to a taxpayer's gross income to determine whether or not a taxpayer should file a tax return. Okay, so you'll have the information to make those calculations. So in class, we talked about different things that would impact this. So taxpayers that are 65 or older get more standard deduction. Taxpayers who are blind get additional standard deduction. Your standard deduction and your personal exemption are dependent upon whether or not someone can claim you as a dependent. We talked about these things in class. So on the exam, we're just going to deal with basic assumptions, okay? So on the exam, if you have to decide whether someone needs to file a return, we're going to deal with single taxpayers. These taxpayers are going to be under the age of 65. They are not going to be blind, and they are not going to be claimed as dependents of someone else, okay? So you can just take the basic information from the tables provided. All you need to understand, all you need to know is that you need to compare their income to the combination of those 2 numbers. No special exceptions are going to apply, and you'll have to tell me whether or not someone should file a return, okay? All right. So that's who has to file a return. We talked about due dates, right? So this is kind of the individual portion of this book, and next semester we'll talk about corporations. So let's talk about due dates for individuals. It's April 15th. I think most people know that. If you can't file your return by the 15th, you can ask for an extension. Extension would be a 6-month extension. That extension is simply to file your tax return, not to pay your taxes. So if you have to extend your return and you anticipate owing tax, you need to send in that tax payment with your request for extension, okay? You need to make that payment by April 15th to avoid any penalties. Okay, then we talked about statute of limitations. So generally, the statute of limitations is going to run for 3 years. And the 3 years, when is that clock going to start? It's going to start the later of the day you actually file your return or the tax return's original due date. Okay, so this is how we're going to decide when the statute of limitation ends. So generally 3 years, but you have to look at the date that the taxpayer filed their return, and that's going to determine when that 3-year clock starts. The statute of limitations is extended to 6 years if a taxpayer omits 25% or more of their gross income, and there's no statute of limitations if a taxpayer is fraudulent in their filing or if they simply opt not to file a tax return. Then the statute of limitations is open indefinitely. Okay, so here's some examples. A taxpayer files, because I don't think we had homework examples that touched on statute of limitations specifically maybe. So here's just a couple of quick examples. We have a taxpayer that files her 2014 return on February 25th of 2015. When would the statute of limitations end for this taxpayer? So again, the statute of limitations is generally, it runs for 3 years after the later of the filing date or the tax return's original due date. So in this example, the taxpayer filed before the original due date of her tax return. So the actual or the return's due date is going to drive the statute of limitations in this scenario. Okay, so it's the later of her actual filing date or the return's due date. Here, the return's due date would have been April 15th of 2015. That's what's going to start the clock for the statute of limitations. It's going to run for 3 years. So the statute of limitations for this return closes on April 15th of 2018. Okay, so in the next example, let's say the taxpayer files her 2014 return late. Okay, so it was due on April 15th, but she is not able to file until November 1st of 2015. So again, the clock for the statute of limitations starts running the later of the actual due date, the original due date, or the date that the taxpayer actually filed. So in this example, the date of actual filing is the later of those 2 dates, and so that's what's going to start the clock. So for this return, the statute of limitations would end on close on November 1st of 2018. Okay, so the third one, the taxpayer never files his 2014 return. So this happens. Sometimes people just fail to file. So if this is the case, the statute of limitations would never close. Okay, the IRS could request this return or information regarding this tax year at any point in the future. Okay, so there's no statute of limitations at all. And then finally, a taxpayer files his return on March 28th. This taxpayer is a waiter, okay, or a server in a restaurant, and he failed to report his tip income, okay, so he just, because it was cash income, he thought, oh, maybe I'm not going to get caught, and he just didn't report that cash income on his return. This income represented 40% of his gross income, okay, so most of his income comes from tip income. Because he didn't report the tip income, he underreported his gross income by 40%. So for this tax return, the statute of limitations would not end until April 15th of 2021, okay? So if you underreport your income by more than 25% of your gross income, instead of a normal 3-year statute of limitations, your statute of limitations becomes 6 years, okay? So this particular tax return, the IRS could come back up to 6 years after the original due date of his return to request more information about that return or to audit that return. Okay, so that's statute of limitations. We talked about IRS audit selection, how you might get selected for an audit, and what type of audit you might be subject to. So the main ways we talked about in terms of audit selection were the whistleblowing program. Okay, maybe you get divorced and your spouse isn't very angry with you and turns you in for tax evasion, or maybe you leave your company and you're disgruntled, and so you turn your prior employer in. So these things that are probably going to fall under the whistleblowing program. We talked about the DIF program, or the discriminant function program. Again, this program is looking for patterns in your return. So an example would be you're taking very large charitable donation deductions for someone with similar amounts of income. So the IRS has a bunch of statistics. They kind of know what normal or average tax returns look like for people in certain income tax brackets. So if you're taking deductions that are kind of out of line with what your income is, then you might get selected for audit under this DIF program. The Document Perfection Program, all returns are checked for math errors. If you've made a math error, this Document Perfection Program is going to catch that error and you are going to get a notice. And the Information Matching Program, again, things like W-2s. You work, your employer sends you a W-2, your employer also sends the IRS a W-2, and the IRS is going to make sure that all of the information that was reported to the IRS shows up on your return. If it doesn't, you're going to get a notice, and that's the Information Matching Program. Talked about types of audit, correspondence. This is the most common type of audit. So this is you're communicating back and forth with the IRS on one specific item, 2 specific items. That's a correspondence audit. Most likely, if you're dealing with a correspondence audit, it's because the IRS found an inconsistency within your return based on the Document Perfection Program or the Information Matching Program. Okay, so that's what's probably going to generate a correspondence audit. The other 2 types of audit are an office audit or an office visit. That's when you go to the IRS and talk to the agent there, and then a field audit is when the IRS comes to you. Okay, so probably those types of audit, maybe the DIF program or the whistleblowing program is what's going to initiate one of those types of audits. Okay, what happens after the audit? Okay, so you're audited. The IRS agent is going to provide you with a list of proposed adjustments, what they think you've done wrong on your return. If you've done some things wrong on your return, that's either going to result in you having to pay additional tax, or possibly you made mistakes and correcting those mistakes will be in your benefit, so maybe you're due a refund now. Okay, but the IRS agent is going to complete the audit process. They're going to kind of come up with a list of things that were done incorrectly on your return, and they're going to give you that list. Okay, and these are going to be the proposed adjustments. When you get this list of proposed adjustments, you can agree and pay the additional tax, or you can agree and accept the refund if you've made mistakes that were not in your favor on your originally filed return. So you can agree and deal with it like that. If you disagree, okay, and you don't agree with the list of proposed adjustments, then the IRS agent is going to produce a 30-day letter. They're going to give you a 30-day letter. The 30-day letter provides you 30 days to either pay the tax, okay? Agree with the proposed adjustments, but if you don't agree, you have 30 days to request an appeals conference, okay? An appeals conference, you're going to an appeals officer, someone different than the IRS agent that you've been dealing with up to this point, and maybe you can come to an agreement with the appeals agent. Okay, so the 30-day letter, again, gives you 30 days to either say fine and pay the tax or to request an appeals conference. So maybe within the appeals conference, you can come to an agreement with the IRS, okay? Maybe you'll talk about the list of proposed adjustments. They'll give a little, you'll give a little, and you guys can get happy. In that case, then you would pay the tax and the issue would be closed. If you can't get happy with the appeals officer, then what's going to happen if you can't get happy, you can't come to an agreement, then you're going to receive a 90-day letter. Okay, so the 90-day letter is going to be if you've dealt with the agent, dealt with the appeals officer, and you still think that they're wrong, okay, and you're not going to pay the tax. Then you're not going to agree, I guess, to the proposed adjustments, then you'll receive a 90-day letter. The 90-day letter gives you 90 days to go ahead and pay the tax, or you have to file a petition in tax court. Okay, so that's what the 90-day letter would be. Okay, so let's say we're done here at the 90-day letter. You're sure that you're right, you're not going to give in. You get the 90-day letter, so you either have to pay the tax and sue the IRS for a refund in district court or the Court of Federal Claims, or you can not pay the tax and file a petition in tax court. Okay, so I wanted to kind of just really quickly talk about this diagram. So in this diagram, ignore the thing at the bottom, okay, ignore the U.S. tax court small claims. We did not talk about this in class, and it's not something that's going to show up on the exam, okay, so ignore that portion of this diagram. But we did talk about everything else, okay? So if you get a 90-day letter and you know you're going to court because you can't get happy with the IRS, then you have a decision as to where you go to fight this out with the IRS. You have a decision which court you want to file your petition with. You can go to district court, okay? You can go to tax court, or you can go to the U.S. Court of Federal Claims, okay? So in class we talked about why you might choose one option over the other. So tax court has judges that are tax experts, okay? So if you're very confident in your position, you might want to go to tax court. And again, tax court is the only place you can go if you don't have the money or you are unwilling to pay the tax up front, okay? So you can go to tax court without paying the tax first. U.S. District Court and the U.S. Court of Federal Claims, to start here, you have to pay the tax first, and then you're suing the IRS for a refund. So district court, why you might choose district court is because it's the only place you can go to have a jury trial. So if you have a very sad story and you think that a jury might work to your benefit, then you would want to go to district court, okay? So aside from those kind of differences amongst these trial level courts, another thing that you'd want to consider is the precedent of each court. And again, the district court, okay, the U.S. District Court has to be consistent with its previous rulings, okay, and then U.S. District Court would also have to be consistent with the Circuit Court of Appeals rulings as well, okay. The tax court has to be consistent with itself, and it also has to be consistent with its appellate court, which is also these 11 circuit courts, okay. So the U.S. District Court and U.S. Tax Court, they have to be consistent with their own prior rulings, and they also have to be consistent if you would go to appeals, okay. Then you would be under these Circuit Court of Appeals, and these lower level courts have to be consistent with their own appellate court, okay? Or you could go over here to the U.S. Court of Federal Claims. So the U.S. Court of Federal Claims has to be consistent with itself. It also has to be consistent with its appellate court. Its appellate court is the U.S. Circuit Court of Appeal, okay? This is a separate circuit court from these 11 circuit courts of appeal, okay? So these are two different systems, two different appellate courts, okay? So you'd want to look at precedent, and you'd want to make sure that you have your case heard in a system that is going to work to your favor, okay? So let's say that you are disagreeing with the IRS and you reside in the Second Circuit, okay? And you just recently read a case at the Second Circuit Court of Appeals that is against your position. You reside in the Second Circuit, and the Second Circuit Court of Appeals has just ruled on something similar to your situation, and it was not taxpayer friendly. If that's the case, then you would want to have your case heard over here in the U.S. Court of Federal Claims. Okay, you'd want to come over here because once you're over here, okay, at the U.S. Court of Federal Claims, then the U.S. Court of Federal Claims has to be consistent with its own Circuit Court of Appeals. It does not have to be consistent with the Second Circuit Court of Appeal, the Second Circuit, because it's not within that system, okay? So if you reside in the Second Circuit ruled unfavorably to your position, then you'd want to have your case heard in the U.S. Court of Federal Claims, okay? And then if you were to appeal, you'd go to the U.S. Circuit Court of Appeal and have your case heard there, okay? And that precedent that's not in your favor isn't going to, cause as many problems for you if you are within this system, kind of on the right-hand side of this diagram, okay? And then similarly, if you're sitting in the Second Circuit, okay, and the Second Circuit issued or ruled on a case and it's really favorable to your position, then you'd want to start in district court or you'd want to start in tax court. You'd want to start in one of these two courts because if the Second Circuit Court of Appeals has ruled in your favor, you want that precedent on your side, okay? So you'd want to get into a court system that's going to take that case into consideration and give it a lot of weight, okay? So this diagram I think is important for you to kind of understand this idea of precedence and to really hit home that you want to start in a trial court where previous rulings are going to work in your favor. If they're not going to work in your favor, then you want to kind of jump to the other trial court. And then you want to start kind of on the other side of the diagram, go choose a different trial court to try to get more favorable previous rulings, okay? All right, so we've already talked about this, okay, the top half of the slide. So the second half of the slide, primary versus secondary sources of tax law. Primary sources are all of your official sources of tax law. So it's important to understand that each source does not hold equal weight. Some are more important than others, and you need to understand that level of importance when you are making recommendations for your clients and when you're considering which court to go to if you're disagreeing with the IRS. That would be the primary sources, okay? So they're official, and you need to understand that they all don't hold the same authoritative weight. Secondary sources of tax law, these are unofficial sources. They're going to hold no weight if you go to court, and examples of these would be your textbook, practitioner journal articles, CCH's Master Tax Guide. Okay, we talked about some of these things. All right, so looking at primary sources of tax law, there's legislative, judicial, and administrative sources. Legislative would be the Constitution, which doesn't give it, that just gives Congress the ability to tax. We don't worry about that too much. We have the Internal Revenue Code. That's our primary source of tax law within the U.S., and tax treaties, which are going to guide taxpayers that have international tax concerns, maybe income from two different countries. So a tax treaty would be helpful for them to deal with their tax situations. For this class, we're going to deal with the Internal Revenue Code, okay? That's going to have the highest authoritative weight. The code, tax treaties, and the Supreme Court, they all have the highest authoritative weight. If it's clear what we should do based on these sources, we need to follow it. If we don't follow it, we're going to get nailed in an IRS audit, and we will not win if we go to court, okay? So judicial sources, we started with the Supreme Court, talked about that. Supreme Court doesn't often rule on tax cases or agree to hear tax cases, so not so many Supreme Court cases dealing with tax situations. Then we have the appellate courts. Again, that's back to the appellate courts would be the U.S. Circuit Court of Appeal and these 11 Circuit Courts of Appeal that we talked about. Those cases hold more weight than the trial level courts. The trial level courts being district court, tax court, and the U.S. Court of Federal Claims. Okay, so within the judicial sources of tax law, if the IRS loses, okay, so taxpayer is victorious, IRS loses in court. The IRS, not always, but they might issue a statement of acquiescence or non-acquiescence. If the IRS issues a statement of acquiescence, this is the IRS saying, we are not going to litigate this issue anymore. Okay, we acknowledge that we lost in court, and the court's not going to side with us, and so we're not going to push the issue any further. if there was a statement of, if you're relying on a case where the taxpayer won and the IRS has issued a statement of acquiescence, this would make you feel good. Okay, this would make you feel better about relying on that case, especially because it's that, because it's the IRS saying if other taxpayers do similar things, we're not going to fight with them. We're going to kind of follow the guidance from this court case. If the IRS instead issues a statement of non-acquiescence, what this would indicate is that the IRS is not going to stop litigating this issue. Okay, the IRS does not think that the court made a correct ruling, or maybe there was something very specific about this case that doesn't apply to most taxpayers, and the IRS thinks that if they continue litigating with other taxpayers that they have a chance to win on this particular issue. So if you find a case and the taxpayer has won, and you also find out that the IRS has issued a statement of non-acquiescence, then you should just realize that if the IRS has issued a statement of non-acquiescence, that you can rely on that case, okay, but you still might get audited and you still might end up in court because the IRS is not backing down from their position, okay? So acquiescence and non-acquiescence. And then finally, administrative sources of tax law, Treasury regulations, revenue rulings and revenue procedures, and private letter rulings. These are in kind of decreasing order of, it's listed in decreasing authoritative weight. Regulations hold the most weight, private letter rulings hold the least weight. Okay? And then if we would add things like practitioner journal articles or things from your textbook, they would hold the least amount of weight, right? Because you can't even rely on those if you go to court. All right, the final thing from Chapter 2 is we talked a little bit about professional standards. So sometimes the tax law is a bit unclear, and there's professional standards that say, that should guide your decisions based on how aggressive or how conservative you feel comfortable being when you're giving advice to your clients. What our professional standards are for tax services is that we can only make recommendations that have substantial authority to avoid penalties, okay? So one option to avoid penalties is to make sure that all of our positions have substantial authority. A substantial authority means that we feel that we have a 35 to 40% probability that we will win if audited. Okay, so that's substantial authority. Alternatively, if we don't have substantial authority, if we don't think we meet this 35 to 40% probability level or probability threshold, we can still take a position if we feel that we have a reasonable basis. Reasonable basis means we found something out there that says we should treat our transaction in this way, but we don't meet this probability threshold. If we take a position that falls short of the probability threshold, if we disclose it on the tax return, we can still avoid penalties. Okay, if we have a reasonable basis plus disclosure, then we can avoid penalties. Taxpayers are held to the same standards. Okay, so we as CPAs or practitioners might get hit with penalties if we don't meet these standards. Taxpayers can also get hit with penalties if taxpayers don't meet these standards. The standards are the same for both practitioners and for taxpayers. Okay, substantial authority or reasonable basis with disclosure. All right, so finally, Chapter 3. We only talked about very specific timing strategy with Chapter 3. So we're looking at whether, if it's possible, then there could be a benefit to accelerating our tax deductions into the current year and delaying income recognition into the next year. Okay, so if we expect our rates to be constant, what we talked about is benefits related to paying our bills quick this year and taking the tax deduction this year, and if we can, delaying our income recognition into the following year. We also talked about how this really only works for cash basis taxpayers. Cash basis taxpayers have the ability at the end of the year to make very small adjustments to when they receive cash or when they pay bills. So we're talking about accelerating bill payment by a couple of weeks or delaying cash receipt for a couple of weeks. But within this couple of weeks' time, we're able to manipulate when we have to pay the tax or when we realize the tax savings by an entire year. Things that happen in December get reported on this year's tax return. Things that happen early January happen on next year's tax return. And there could be benefit in us making these kind of small manipulations in our cash flows to bigger benefits on our tax return. Okay, so this is only going to work if we can manipulate it in these small time frames. So this is from your homework. So I'm going to go over both homework examples. So we have Isabel. She's a cash basis taxpayer. In late December of this year, she received a $20,000 bill. She can pay the bill anytime before January 30th of 2015 without incurring a penalty. Her marginal tax rate is 40%, and she doesn't expect it to change. She uses a 12% discount rate. When should she pay the bill? Okay, so again, so she can either pay the bill like December 28th when she gets the bill in late December, or she can wait 30 days and pay it in January. So the difference in when she pays the bill is very short, okay, but the ramifications could be more significant. If she pays the bill now in December, she'll report the deduction on her 2014 tax return, and she realizes the tax savings in early 2015 when she files her return. If instead she waits and pays the bill in January, then she waits and reports that deduction on her 2015 tax return, and she won't realize the tax savings until she files her return, and that won't happen until 2016. Okay, so by waiting 30 days to pay the bill, she has to wait an entire year to receive the tax savings. Okay, so how would we make our decision? We can compare December versus January. The amount of the deduction is the same. Okay, the bill is $20,000. That's how much we have to pay. The tax savings is going to be the same. Okay, again, we take the deduction times her marginal tax rate of 40% to get a tax savings of $8,000, and that's the same whether we pay in December or we pay in January. Okay, the difference is going to be in the present value of those tax savings. So if we pay in December, we get those tax savings really soon, and so we don't have to discount anything back to the present value. Our discount factor is 1, okay? How much is $8,000 worth very soon? Well, it's worth $8,000, okay? And so that's the present value of our tax savings. We can look at the after-tax cost by taking the amount of the deduction, netting that with our tax savings. Our after-tax cost would be $12,000 if we pay in December. Okay, if we wait and pay in January, then again, our deduction is the same, tax savings is the same, except now we have to wait an entire year to get those tax savings. If we have to wait an entire year to get the tax savings, then we need to discount just the tax savings, okay? The $20,000 is happening very soon, so we don't discount that back, okay, to the present value. We're paying that bill in 30 days, okay? So the value of our money is going to stay more consistent over a 30-day window than it is over a year window. So when we're discounting things back to the present value, it's just the tax savings, because in this example, the tax savings is the only thing that is being delayed by an entire year, okay? Not the actual payment, just the realization of the tax savings. So we find the discount rate, okay, or the discount factor, based on a 12% discount rate and a 1-year period of time, and the number that's going to show up on that present value table is 0.893. I will provide the tables for the exam, okay? So we apply that discount factor to the amount of our tax savings, and the present value of our tax savings, $7,144. That's less than the tax savings if we pay the bill in December, which increases our after-tax cost, okay? So based on this analysis, we want to pay the bill in December. Okay, why do we want to pay the bill in December? Maximizes our tax savings, reduces our after-tax cost. On the exam, you can't just say they should pay the bill in December. I need to make sure you understand why they need to pay the bill in December. So on the exam, if you have a similar question, you'll have to tell me they should pay the bill in December because the present value of the tax savings is this amount in December compared to this amount in January, or the after-tax cost in December is this amount compared to this amount in January. I'm looking for numbers, actual numbers, to substantiate your recommendation on the exam. Okay, so this is highlighting why this is only beneficial if the cash transaction is only delayed by a short amount of time. So here we changed the scenario a little bit. What if Isabel's only option is to pay the bill on December 30th of 2014, or to pay the entire bill on December 30th of 2015? So instead of just a 30-day difference between when we pay the bill, what if the only way to accelerate the tax savings into 2014 is to pay the entire bill a year early? Okay, so this is how we're changing the scenario. In this last example, we're paying in late December or early January. The difference is a few weeks. In this example, we're paying the bill on December 30th of 2014 or December 30th of 2015. So now there's a year delay in when we actually pay the bill. Okay, so again, the deduction is the same, the tax savings the same. okay, we can come up with our net cash flow, okay, or the after-tax cost of this deduction is $12,000, and now we have to apply our discount factor. In this example, we only applied the discount factor to the tax savings because that's the only thing that's pushed into the future. But in this example, we're not paying the bill until a year later too, okay? We're delaying the payment of the bill for an entire year. So now when we look at the discount factor, we take it on this net cash flow because both of these things are happening a year from now, okay? Once we do that, then the present value of our cash flows is going to be less if we wait and pay the bill in 2015, okay? So this is going to change our decision. In the last example, we want to pay the bill in December, okay, to reduce our after-tax cost. In this example, if we can wait an entire year to even pay the bill, then we want to do that. We want to wait an entire year because by waiting an entire year, the present value of the $20,000 payment that we're making is going to be reduced, right? We're paying with cheaper money if we can wait a year to do that. And if we look at these present value of our cash flows, this is like our present value of our after-tax cost. And now it's less expensive to wait and pay the bill in 2015, okay? So then our decision would change. Instead of paying it in December of this year, we'd want to pay it in December of next year, okay? Again, why? And now in this situation, the benefit of paying the bill a year later, okay, the benefit of delaying this $20,000 payment outweighs the benefit of realizing the tax savings a year early, okay? So if we go back to this example, the difference in our tax savings, this is where the value is coming from in this example, right? This is why we want to pay that bill in December under these circumstances because our tax savings are greater. Our tax savings are greater by $856, okay? And that's what's driving the benefit if in the last scenario. But in this scenario, we're delaying two things. We're delaying the tax savings, okay? And by delaying the tax savings, we're missing out on this $856 benefit, okay? We lose that benefit. But the benefit that we're realizing by paying a year later is the benefit of delaying the entire $20,000 payment into the future, okay? So if you look at the present value of just the $20,000, if you look at the present value of $20,000 using this discount factor, okay, then the difference in the present value of $20,000 a year from now, okay, if we look at the present value of $20,000 and today versus $20,000 a year from now, the difference in those amounts is going to be $2,140, okay? And so if you subtract these two numbers, okay, $12,000 minus $10,716, if you subtract those two numbers, you're going to get something like $1,400. And then if you net these two numbers together, subtract the $856 from the $2,140, you're going to get that same difference, okay? So right here, I'm just showing you kind of the lost benefit by paying in 2015. We lose the benefit of the accelerated tax savings. However, the benefit of delaying the payment is going to be much more than the benefit of accelerating the tax savings. So this would be the benefit of paying in 2014. This is the benefit of paying in 2015. This benefit, far exceeds the $856 benefit. Again, if you subtract $856 from $2,140, you're going to come to the difference between these present value cash flows, okay? So the difference in these two numbers equals the difference in these two numbers, okay? I'm hoping you can see my mouse. And then again, where does this $2,140 number come from? That is the difference between $20,000 and the present value of $20,000 a year from now, okay? Based on a 12% discount rate, okay? So that's the deduction example, okay? And then there's an income example. I'm already an hour and 15 minutes in, so we'll do this one very quickly. Manny uses a cash method for his small business. In late December, he performs $20,000 of legal services for a client. Manny requires immediate payment as soon as he gives his client a bill. He just requires them to pay right away. His marginal tax rate is 40%. He also uses a 12% discount rate. So if he's expecting immediate payment, when should he send out the bill? In December, or should he send out the bill in January? Similar to the deduction example, we're talking about maybe a couple of weeks of when he's going to receive the cash, but a big impact on when he actually has to pay the tax. If he sends out the bill in December and gets the cash in December, then he has to report the income in 2014, pay the tax when he files that return in early 2015. Okay, if he waits and sends the bill in January and receives the cash in January, now this is income that he's reporting on his 2015 tax return, and he gets to wait a whole year before he has to pay the tax. Okay, so again, similar analysis. We have taxable income of 20. The tax cost on this income is the amount of the additional income times our 40% marginal tax rate. The tax cost is going to be $8,000 under both scenarios, except we have to discount the tax cost back. The tax cost, if we report the income in December, the discount factor is 1, right? Because we're going to incur that payment very soon. And so there's no present value concern or no present value calculation associated with that. So our after-tax cash flow is going to be $12,000 if we pay in December. If we receive the income in December, if we can wait and receive the income in January, okay, we still have the same taxable income, we still have the same tax cost, except we don't have to pay the tax until a whole year from now, okay? We're not going to incur that tax cost for an entire year. So we need to discount that tax cost back to the present value because it's something that's not happening until a year from now, okay? So the present value of the tax cost, if we can wait and pay it in a year, is $7,144. This is reducing the present value of the tax cost, reducing our tax cost, right? If we can push the payment into the future, we reduce the cost of that payment because of the time value of money. If we can reduce the tax cost, we can increase our after-tax cash flow, okay? So based on this analysis, we should wait and receive the income in January, okay? That would be the most beneficial. Receive the income in January, report it in 2015, wait and pay the tax until 2016. Okay, so again, this only works if we're talking about short-term delays in our cash receipt. Okay, so let's say Manny doesn't really understand this very well, and he just kind of focuses like I should just delay the tax payment, but he doesn't really understand why. He doesn't understand the concept. So he decides that the way he's going to delay the tax payment is he's just going to let his client pay next year. Okay, so instead of paying December 2014, he's going to request that his client pay in December 2015. Okay, so now he's waiting an entire year to receive the cash. Okay, waiting an entire year for the $20,000. If this is the only way you can delay the tax cost is by delaying the income receipt by an entire year, you're going to lose. You would not want to make that decision, okay? Why? Let's look at the analysis. His taxable income is going to be the same whether he gets it in December of 2014 or he waits until December 2015. The income's going to be the same. The tax cost will be the same, okay? His after-tax cash flow will be the same, except now this after-tax cash flow, this $12,000, he's waiting and getting that $12,000 next year, okay? He's not going to get that cash until next year. So therefore, because both of these things are happening next year, okay, we have to take the net after-tax cash flow, take the $12,000 times the discount factor, because we're waiting for both things for an entire year. That would, if we take the $12,000 times our discount factor, then the present value of our cash flows becomes $10,716, okay? And now it's clear that getting the cash in 2014 is better, okay? So again, why is this better? Because if we have to wait an entire year to get that $20,000 in cash, then the present value cost of waiting an entire year is going to far outweigh the smaller benefit we get under this scenario where we're just pushing the tax cost out by a year, okay? So similar scenario to the expense, okay? Now, the benefit of receiving the $20,000 a year earlier outweighs the benefit of delaying the tax payment by a year, okay? Again, delaying the tax benefit by a year is going to be the difference in these two numbers, right? This is a big benefit under this scenario, okay? We reduce our tax costs by $856. But by doing it under the second scenario, if the only way we can delay that payment is by delaying the cash flow by an entire year, well then we're missing out on having this $20,000 of cash a year early, being able to invest that, okay? The value of $20,000 today is more than $20,000 a year from now. And the benefit of accelerating the cash receipt under the second scenario is going to far outweigh the benefit of pushing the tax cost out into the future, okay? So again, this is just highlighting why you would only want to do this, okay? You would only want to delay your income recognition or your cash receipt if we're talking about a short delay in receiving the cash, but a long delay in paying the tax. That's when it works. It does not work if the only way we can have a long delay in paying the tax is if we also have a long delay in receiving the income. Okay, so you need to be careful when you're thinking about these timing things. You need to think about the time value of everything going on in the transaction, not just the tax cost or tax savings. So this is going to work best for cash basis taxpayers with the ability to manipulate their income in kind of in short amounts of times to receive a big benefit. Okay, so my apologies, I'm way over, but I think this was actually a pretty good kind of comprehensive review of everything you should be prepared for on Tuesday. So again, I hope you had a chance to listen to this whole thing, and hopefully you're not listening to this late Monday night before Tuesday's exam. So again, if you listen to it before then, please hit me up with email questions or stop by my office on Monday if anything about this was confusing, and we can get it cleared up before you come in and take the test on Tuesday. Okay, so have a great weekend, study hard, and I'll see you on Tuesday for the test.